Hello everyone, welcome back. Hope you've been well. As we're getting closer to the end of February, usually most people are going into the bank at the end of the month trying to get their RSP contributions in. For me, I liken it to watching people rushing into the mall for Boxing Day deals, as they're eagerly awaiting their dollar bills. Today we'll go over what an RSP is and the types of RSPs that you can have. I'll go over some of the nitty-gritty stuff, so hopefully this video will be all you ever need when it comes to learning about RSPs. If you find this content helpful, please leave a like or subscribe, and definitely share with anyone else that you think might need this information. So, RRSP. This stands for Registered Retirement Savings Account. A lot of people used to use this account and still do use this account to essentially fund their retirement. So the idea is that you keep building up this account, and then when you retire, this will essentially be your life savings. This is the nest egg that you build so that you can start pulling from it in retirement. Now, there are a couple other types of accounts that people are starting to use nowadays. For me, I also really like the tax-free savings account, which I'll get into in another video, but this is kind of the old tried and true method. So there's three main types of RRSP accounts that people can have access to. First, we have the individual RRSP. This is kind of the most common one. This is the one where you go into a bank, for example, Bank of Montreal or TD Bank. You'll open it yourself. You'll go to a teller and you'll say you want to open up an RRSP account. A financial advisor in there will help you open one up. And so this is opened up in your own name. Any benefit that you get from your contributions are directly to you, and it happens pretty much instantaneously. The really great part about this is you can do this entirely by yourself if you want. It doesn't limit you to any type of investment options. So that means that in here, you can have just cash. You can have a GIC, which basically pays you a guaranteed return. You can go for something a little bit more growth focused, which would be something like a mutual fund or even an index fund. You can also hold physical assets here as well. For example, you can actually buy like gold bars if you want to invest in gold, and instead of investing in gold stock, you can actually buy physical bars and have that in your RSP account, which is kind of cool. Or if you really want to get out there, right now, obviously with the craze, you can buy something like Bitcoin. The second most common, or the second other very common type, is what is called a group RRSP. This is usually offered through the employer. So if you work at a company that offers a group RRSP, usually how that works is in your benefits package, which everyone should review. Basically, they will have some sort of matching promotion. Some of them, for example, might be you deposit 3%, the company will give you 3%, or if they're really nice, maybe they'll just give you a free 3%. Each company does their own thing a little bit differently. And this is obviously assuming if you have a defined contribution plan under this group RSP. There is another type of benefit plan, which is called a defined benefit plan, but we won't really go into that because it doesn't fall into the RSP. And quite frankly, if you have a defined benefit plan, you don't really need an RSP because usually those are enough to fund your retirement. Now, the benefit, of course, is you get free money, right? Whatever they match is essentially free money, which is why everyone needs to review the benefits package. But the downside is it's usually restricted by whichever financial institution manages that group RSP. So for example, if it's through Manulife, you might only be able to buy Manulife products. Or if it's done through Sun Life, you might only be able to buy Sun Life products, right? Some of them are also really nice if they let you choose whichever investment option you want. But what's really great here is usually the employer will contribute partially to your retirement, which essentially is free money. And lastly, here we've got the spousal RSP. So this is only for people that are married, and Usually what this is you have the higher earning spouse. They are able to contribute to the lower earning spouse's RSP. So for example, I'll go into a more detailed example later, but just real quick, if you're making $100,000 and your partner makes $50,000 and you think that during retirement, you guys might have similar incomes, or maybe if they have less income than what you might have, that's even better. But the benefit is that you get to take money out of your taxable income, contribute it to their RSP account. You will get the tax deduction, but when you take the money out during retirement, they will be the ones taxed for it. So it kind of allows for splitting up retirement income. And that is basically a strategy for tax planning. And pay attention. What I said was earned income. So what does earned income entail? Well, earned income could account for, let's see, we have rent. Well, obviously, let's go with work. So employment income. So your regular, 9 to 5, if that's what you do. It can be stuff like rental income, if you've got a rental property. It can be stuff like alimony or spousal support. Right? So these all are ways that it calculates your earned income. So somebody who might not do a 9 to 5, but if they've got a lot of rental income, they can also contribute that to their RSP. And of course, anything that you do with business income, right? If you have a small business. So that's how they calculate contribution room, right? 18% of your earned income. Now, what's important to note is that the contribution room that you get per year carries forward indefinitely. So if you have $5,000 worth of contribution room this year that you got, and you don't contribute any of it, that $5,000 will carry over to the next year, and you could put it in then. And you might ask, why would I not just contribute all of it, right? Well, we'll go into that a little bit later when we talk about, streamlining and making sure that you're getting the most out of your money. And for the contribution, there's a $2,000 lifetime over contribution allowance before you get penalized. So let's go back to that $5,000 contribution room example. You can actually contribute $7,000 and the government's not going to smack you. But if you did $7,001, then they will actually penalize you for that extra dollar, and the penalty is 1% per month. So it can actually get pretty steep if you think about it. They're essentially penalizing you 12% a year on your contribution, right? And think about how hard it is to make 12% a year on your money. So next you have the flip side, right? Sometimes when you're putting money into your RSP, even though you're saving for retirement, you might need it. Maybe it's an emergency. Maybe you need some little bit of extra cash because you want to buy something. That's when you need to withdraw out of your RSP. So in that individual RSP, this one right here, usually you can take it out anytime. For the group RSP, it's a little bit different. You do have to double check with your employer what type of RRSP that they are offering you, right? A lot of them can be locked in and usually are locked in, which means the money that they're contributing, on your behalf, or the money that they're matching, that's locked in. You can't touch that money. And if you're contributing into that same account, it ends up being locked in as well. So that's just something to keep in mind when you're going over the type of account that they're giving you. But usually on the individual RSP side, it's 99.9% of the time, you're going to be free to do whatever you want with it. Now, because when you put money in, you're getting the tax back, right? When you withdraw the RSP, because they don't know exactly what your situation is, the government automatically puts on a withholding tax rate, which means that when you take up to $5,000 out of your RSP, they are going to hold 10% back. So you will only get $4,500. If you take out $5,001, now they're going to take 20%. So the next bracket is $5,000 to $15,000. They're going to take 20% right off the top. You're never going to see it when you do the withdrawal, that is. And then if anything above $15,000, you're looking at a 30% withholding tax rate. Now, this does get reassessed. So when you file your taxes the next year, what will happen is the government will take a look at exactly how much income you earned the year prior, and they will end up readjusting based on the proper tax rate that you should be taxed at. So if they took too much on the withholding tax, they'll actually give some of that back to you. If they actually took too little, then they'll issue you another bill for any extra that you haven't paid. So in Canada, there are 2 times in your life that you can take money out of your RSP tax-free. So the first one's called the First-Time Homebuyers Plan. This was so that the government could help people try and afford homes, right? Especially first-time homebuyers, especially with how hot the real estate market is in Canada. So you can take up to $35,000 per person from your RSP tax-free. So the withholding tax that we just talked about doesn't apply. You get the full amount. But you do have to pay that back within 15 years in order to have it not be taxed. If you don't pay it back, then it'll get added back onto your income and then you'll get taxed again. It's $35,000 per person. So if you and your partner are buying, you can actually take out $70,000. The other time is the lifelong learning plan. So this is a method to promote further education. You can take up to $20,000 to pay for further education, meaning your master's or any other type of furthering education. And you get 10 years to pay that back. So here we'll get into some of the nitty-gritty stuff. So you can kind of take a look at your picture to see what is going to work for you, because not everyone is going to have the same solution when it comes to how much should I contribute, or should I even contribute, or how do I structure it so that during retirement it's the best for me. So what everyone needs to do is they need to at least first review the income tax brackets so that they're familiar. And I'll show you why. So here's the income tax rates for 2021 and 2020. For me, I'm going to go through BC because that's what I'm familiar with. This site essentially shows you what the current tax rates are for both federal and provincial tax brackets. And that's really important because one thing that people might not know is that taxes in Canada are calculated at the marginal level. So what that means is for the first tax bracket of 42,184, actually let's go with 2020 because that's the year we're focusing on. So the first $41,725, you get taxed at 20%. Oh, and actually what I should mention is there is a basic personal amount. So 2021 and 2020. Basically what that means is there's a federal and provincial basic exemption tax amount, meaning that if you make below these figures, you don't actually you don't pay any tax. So back to marginal tax rates. So the first 41,725 minus the personal exemption, you are paying 20% combined federal and provincial income tax. Once that goes to $41,726 up to $48,535, on that $7,000 range, give or take, you're paying 22.7%. So if your income is, let's say, $50,000, and for, just simple numbers, we're going to ignore the basic exemption for now. But let's say you make $50,000, right? If you make $50,000, you're going to take $50,000 minus $48,535, and that difference, you're going to pay 28.2%. From $41,725 to $48,535, you're going to pay 22.7%. And then on the first $41,725, you're going to pay 20%. So that's what the marginal tax system in BC. So when people say that, oh, I make $200,000 and I'm getting taxed 50% of my money, they're only paying 50% of their tax, or in reality right here it's 46.02% in BC anyway. They're paying that on only the amount above 157, right? The first $50,000 of income that they make, they're paying the same tax as any other guy making $50,000. So knowing that knowledge, we need to go back to our contribution room, right? We know that you can do 18%, or you get 18% of your earned income as contribution room every year. And that contribution room carries forward indefinitely. So if, let's say, your income and you're making, $40,000 this year, right? You're going to get taxed 20% of that income, and you'll get 18% of that as contribution room. But should you be contributing into your RSP if you're only getting taxed at 20%? Maybe what you want to do is you want to wait until maybe you're making $48,000 and above, right? Once you're above this range, you're actually getting taxed at 28%. So what you can do is you can save that contribution room up as you're working and carry that over to the future, so that once you're making more income, you can then get more back on that dollar you contribute, right? Because right now, if you're at $40,000 income, when you contribute, let's say $100 into your RSP, you're getting $20 back because that's how much tax you paid. But if you are making $50,000 income and you contribute $100 into your RSP, you're going to get $28.20 back, right? So you can see how streamlining and planning your estimated income and planning how much to contribute to your RSP is actually really important, because you can see these income tax rates. Sometimes they're pretty close. There's not too big of a difference, right? 2% between these two tax brackets. But between 48,535 all the way up to 83,451, you're getting a pretty significant, almost 6% jump when it comes to tax rates. You see another similar one here between 97,069 and the 116,344, right? That's another almost 6% tax jump. So it's really important, if you want to maximize your money, which I can't imagine why you wouldn't, to pay attention to stuff like this, to find out exactly how much your contribution is going to get back to you at the end of the day. And the other thing that you want to do is, because these dollars are so close, what you really want to do is you want to make sure that when you're contributing into your RSP, you're not dipping below the tax bracket, right? So if you're making $100,000 this year, maybe you only want to do a $3,000 contribution, because that way you're getting the max, or not the max, but you're getting the maximum value of the 38.3%. Anything over that $3,000 is now going to drop you into this tax bracket, right? Which is the 32.79. So you're getting less back per dollar that you contribute. Now, obviously, this isn't to say that you should keep waiting and keep waiting and keep waiting so that maybe one day you can hopefully make, over $150,000 and you're getting a ton of contribution room back, tax dollars back because of the high tax rate. Because otherwise, you might not be contributing at all. And what you'd be missing out on in that sense is you'd be missing out on the tax-free growth that you can get in the RSP. The general rule of thumb is wait to contribute to your RSP until you're in this tax bracket, this 48,535 up to 83,451, right? In this tax bracket, you're getting back a decent chunk of change, and you're building up contribution room from these two previous. And the main reason why it makes sense is also because when you're in retirement and you're pulling money out of your RSP to live, you're getting taxed on that, right? So then you get to make money on both ends. You get to make money on, number one, getting 28.2% back, but maybe in retirement, you don't need to pull $50,000 out of your RSP a year, right? You'll have your CPP, you'll have OAS, those are pension incomes. Your work might be giving you a pension income. And so maybe you don't need to pull that much out of your RSP in retirement. Maybe you're only pulling $20,000 a year. So that way you can get taxed at a lower tax bracket. So you're making the difference on 28.2 minus 20%. You're getting a whole bunch of tax-free growth between the time you contribute and the time you take it out. And you're maximizing that 28.2% that you get back right now, right? So, for me, I followed something very similar. I definitely didn't contribute anything while I was below this 48,535, and even afterwards, I make sure to realistically take a look at how much expected income I might earn in my career, right? If my prime earning years are ahead of me, which they should be, usually that's your kind of 40s and 50s. Those prime earning years, if I'm going to be up higher here, I'm going to make sure I save a little bit of contribution room for these tax brackets. So what I do now personally is I take a look at where I am on this spectrum, and I contribute the amount that will just lower me into the tax bracket, right? So for example, if I'm making $85,000, what I'll do is I'll contribute $1,500 to get the 31% back, but I won't contribute any more below that because I want to save that for the future. Or if I'm making, $80,000 or $50,000, it won't be a huge deal because this tax bracket is huge, and I'll just contribute, maybe whatever's enough so that I don't have to pay any taxes. But if I was at, 120, I would do something very similar, right? If I was at $120,000, I'd contribute $4,000, get my 40%, and I'd leave the rest, assuming that I think that I can make more because my prime earning years are still ahead of me. So everyone's situation is going to be a little bit different, but that's kind of a ballpark or a way to gauge how you should be treating your RSP. So going back to this list, like I said, review expected future income and income in retirement. There is an example here, workers with defined benefit plans, usually government workers. So this will be like police officers, firefighters, teachers. Usually they'll still have pretty high earnings in retirement because they're on what's called a defined benefit pension plan. So usually a defined benefit pension plan, everyone's is different, but the generic one is, based on your years of service, so how long you've worked with the company, they'll pay you out a certain percentage of your salary, and it's usually your, average of your 5 highest years of salary, right? So they might get, $60,000-$70,000 a year from their pension. And so if they contribute to an RSP, that doesn't really make a whole lot of sense because now in retirement, when they pull money out of that RSP, they're still going to be taxed at a very high tax bracket, right? So it's better for them to just invest in the tax-free savings account. And if that's maxed out, maybe they do the spousal RSP option or they do a non-registered, right? Now, one thing you can do is you can contribute now and file it into your contribution room later. So this is a really great option because it allows you to take advantage of tax-free growth inside the RSP for a while. But because it's a little bit more complex for tax filing, I would definitely review it with an accountant or really brush up on tax law. Now, we did talk about higher growth products and how one of the benefits of the RRSP is that growth inside is tax-free. So here I want to show you how the tax-free growth inside the RRSP can affect you and why it's a little important, and to be quite honest, I think it's very important to pick more higher growth focused investments in the RRSP. So for example, let's assume you have $10,000 in your RRSP, or you can put it in any investment, right? You contribute $5,000 a year. If you're making the savings account rate right now, which I think is something like 1%, and you let it compound annually, and let's say you've got 35 years to let it grow. More realistically, if you were using the age of 65, you're going to be between that 35 and 40 year range if you're starting early enough. So let's take a look at 30 years. If you go calculate, these are the results, right? The total value of your investment becomes $222,467.41, and you've earned a total of $37,000 roughly in interest, right? This will kind of show you the graph. Now let's take a look at if you were to get something a little bit slightly more growth focused. If you take a balanced fund, let's assume a 4% rate of return. Balanced fund is roughly 60% stock, 40% bonds or GICs. That's now up to 407%, right? So you're already making almost double your money based on the end net value. If you go to something even more growth focused, right? A full equity portfolio. That's, 6 to 8% historically speaking on average. If we take the middle, we do 7%. Now you're at $800,000 almost, right? You've done nothing when it comes to changing how much you're contributing into the account. All these figures have stayed the same. The only thing that's changed is the type of investment that you're putting it in and the anticipated rate of return on that investment, right? So you can see here how much of a difference, especially when it comes to something like a long time horizon, a growth focused investment, how much of a difference that can make in your ending value. So, one of the beauties of the RRSP is the fact that you're really not supposed to take, much money out of it until retirement. Most people will have 35 or 40 years to really build up on it. And, the other thing that I would mention is it highlights the importance of starting early, for one, and putting in that amount every year that you are supposed to put in. If you're starting early, if you're 25 now and you do 40 years until you're 65, that's over $1 million nest egg that you've got, right? And some people might say, $1 million, that's a whole lot of money. And it certainly is, right? That's a lot you could do with it. And, when it comes to investments and financial literacy, it's really important to understand stuff like this and start early so that you can have a really good retirement, right? It's not to say that, you should never spend money and you should only do this. Balance is extremely important. And to have balance, you also need to be doing stuff like this. Saving early, saving for your retirement, giving it time to grow. And if a higher growth focused investment is something that you're comfortable with, because obviously with a higher growth investment comes more risk, you should really take the plunge and do something like that, right? But the point of this is that people who have a long time horizon should really do something along these lines. You don't have to keep it in cash and make 0.5% interest, right? At 0.5% interest, look at how big of a difference that makes. You don't have to take something as high growth risk as an equity portfolio. You can do a very straightforward balanced portfolio. 50-50, 60-40 is usually the split. You're probably going to get anywhere between 4 to 6% on average, and you're still going to end up a lot better than leaving it as cash, right? And if you've been following along, the portfolio update videos are a way for people to see and get familiar with the ups and downs of the markets. I'm not targeting a really high return. I don't need to target something crazy like, obviously you hear people talk about, oh, they made 20% this year, or they made 30% this year, right? This number is not something that I need. Obviously it'd be nice, but it's not something that I need to target to have a good retirement. I target every year roughly about 8%. If I can make 8% every single year, and ideally more if I can, these are really good figures that I or most anyone can really retire off of, So follow along with the portfolio update videos. Take a little bit here and there and apply that to yourself, right? Get familiar with the ups and downs because there are going to be downturns when you're doing something like this. But the beauty of it is if you've got that long time horizon, anything over 5+ years, you should be investing at least a little bit into the equity markets to get that growth into your portfolio. I will also be doing a separate video on investment vehicles. So in that video, I'll kind of break down into the different types of investments that you can have, so you can really see kind of where the best place is to put your money. Another interesting thing to note, I'll have to drag this over. Pension contributions reduce RSP contribution room, right? So when we talked about here, how you get 18% or 18% of your max income, the group RSP that your company does, their contribution rooms do eat into your contribution room. And it's still a great thing, obviously, because it's free money, but it's just something to keep in mind because it will reduce your contribution room and you don't want to go over too much or else you'll get penalized. Usually the end of February or the first day of March is the last day to contribute for the prior tax year. And so that's why most people end up going in at the end of February. That's why there's that huge rush at the end. I mentioned this a little bit earlier, but it's always important to note. It's a 1% per month penalty for over contribution above the $2,000 lifetime limit. And keep in mind, this is the lifetime limit. So if you over contribute by $2,000 this year, you cannot do that again next year. Otherwise, that penalty will kick in. And lastly, it's really important to plan out the retirement income, as we talked about. One other thing that you might not know is a lot of our government benefits are based on your income. So you might contribute into the CPP and OAS every single year while you're working. But if you're making too much in retirement, you don't actually get that money back. So in essence, you've just paid into the plan and you're not going to get a single dollar back. So it's important to plan out the retirement income to make sure that you're staying below the threshold before you start to get clawed back on those government benefits. Because, you worked really long and hard to get those benefits, right? So it's important to take advantage of those. So that pretty much covers RRSPs in a nutshell. Leave a comment if you think there's anything I missed or if you have any questions on anything else. Everything that we went over today, I'll definitely leave once again in the description and I will share on the Drive folder. So feel free to download it and keep it for future reference. Thanks guys, we'll catch you next time.